Three top dividend stocks that are undervalued with a 30% discount. We're going to look at their historical performance, look at their dividend safety, jump into their financial metrics, and as always, we'll put them through the valuation model, getting to what we believe to be their intrinsic value, as well as the acceptable buy price given our investor margin of safety. And as always, we'll discuss what Wall Street see in terms of upside over the next 12 months. Now, the first company that we're discussing is Bristol Squibb company. Now, this is one that had a horrific 2013, down around 28%. It is towards the mid to lower end of that 52-week range, with a forward yield of over 4%, currently sitting at 4.6%, and a very low forward PE of below 7. Now, if you've been holding this for the last 10 years, you would unfortunately be down 7%. Granted, it doesn't include those dividends reinvested. It is a fairly poor return by any means, and we can see its all-time high not too long ago, the back end of 2022 at $81. So let's take a look about this company. Now, dividend safety score sitting at 70. It is safe. Market cap just over 100 billion. It is a mega cap company. And when we take a look now at those recessionary metrics, last recession they maintained the dividend. In terms of sales, well, negative 21%, which was below the average growth of companies in the S&P, which sits around negative 12%. But they did, in fact, outperform the S&P significantly, negative 32% versus the S&P's negative 55%. Dividend growth, not too bad, 5.3% just last month. It is above that minimum 4% I advocate on the channel, so you are at least keeping up in line with inflation. 7% over the last 5 years. Last 20 years, a bit more worrying at 3%. You do want to, at a bare minimum, keep up in line with inflation, whether that's your dividends, salary, or other income-producing assets. Dividend growth, they have been increasing it for the last 16 years. Now, in terms of dividend yield theory, it states a company is undervalued when that current yield sits above the 5-year average. 4.61 versus 3.15, we have a sign of undervaluation. Keeping in mind, we're not looking at any of these in isolation and drawing our conclusions towards the end. Forward PE, as we mentioned, 6.9, below the 5-year average of 9.2. And when we compare it, it is significantly lower than that healthcare sector PE at 18. Now, in terms of that free cash flow payout, as always, I have deemed and explained this many times, we do focus on the free cash flow. Earnings is susceptible to manipulation by management through accounting. And if you have seen that episode that we dropped earlier today on the essential dividend cut of Walgreens, you would be able to see, in fact, that dividend cut coming from a mile away by focusing on the free cash flow. So anyway, sticking to Bristol Myers, we see over the last 4 years, well below that minimum 60% that we personally look at, as it gives us faith management can offer us those double-digit dividends we love to see. Now, 39% in 2022, expected in 2023 at 42%. That is fairly positive. And when we move on to the free cash flow per share, 183 in 2013. 561 in 2022. It has been increasing over the last 10 years, but do note there are inconsistencies, periods where it does drop and then periods where it picks back up. But overall, over the long term, it is moving in the right direction. But do note 2023's free cash flow per share is expected to be flat on prior year. Sales growth, as always, we want steady, moderate growth, 3 to 7%. And what we can see is, again, some inconsistencies. Just note that in 2022 it was flat, 2023 it is expected negative 4%, so you can understand part of why that share price did drop significantly in 2023. Now, in terms of the total sales, I know a lot of people like to see the numbers, 16 billion in 2013, 46 in 2022, so it has grown, but you can see the inconsistencies from this graph. Shares outstanding, we love it, we love it, we love it when companies do share buybacks, returning excess cash to our pockets. Unfortunately, BYM, as we can see, the net position over the last 10 years, they have in fact increased those shares outstanding, so your position as a shareholder would have been diluted if you have been holding for that period of time. ROIC, I personally like 10% or more, so I know that the company is effectively allocating their capital. But for biotech, you can increase that to 25%. For me, the positives to note is the last 2 years, as well as expected 2023, is above 10%. But again, it really depends on what your criteria is as an investor. In terms of the operating margin, it is one that they have struggled to get above that minimum 25%. 21, 22 sitting in the low 20s. 2023 it has dropped. It is something that I would keep an eye on, as we do see in 2020 it does drop worryingly low to 8%. Free cash flow margin over the last 5 to 6 years, as well as 2023, it is looking very positive above that minimum 20%. Net debt to EBITDA, remember this is earnings before interest, tax, depreciation, amortization, shows us two things. Shows us the balance sheet strength as well as dividend safety. with these numbers showing us the minimum number of years it would take the company to pay off all of their debt net of cash on hand. 1.55 in 2022, pretty much in line with that maximum we look for, although note it is expected to come up slightly higher in 2023. Now, in terms of the valuation model, as always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Now, typically on the channel, if you are a regular viewer, you know we run through all of these models, getting to the intrinsic value, which is generally the average of those four models, although sometimes we do exclude some of these models for different reasons. So the intrinsic value for Bristol Myers is coming to $74 with a current trading price of $52. As always, what we do here is we put a margin of safety of 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data, and we can see how low this goes in terms of what we believe the acceptable buy price to be given the margin of safety. At 20%, it is a buy up to $59, at 25% up to $55, and at 30% we can see pretty much a few cents shy from the current trading price. So we can see for Bristol Myers, you are locking in around a 30% margin of safety to the current trading price. In terms of Wall Street, what do they see? Well, they see the share price to go up nearly 30% over the next 12 months. So in conclusion, for Bristol Myers, we see a 30% margin of safety, with Wall Street expecting 30% upside to the current trading price over the next 12 months. And don't forget, you can click on that pinned comment below where you can get the stock valuation model, getting to the intrinsic value and acceptable buy price of companies in your own portfolio or those on your watch list. Jumping into the second company, we have EPD Enterprise Product Partners. Now, 2013, it wasn't too bad. It did lag behind the S&P, which was up 25%. It did come in around 10%, and we can see currently it is in the mid to upper end of that 52-week range. Forward PE of just under 11 with a strong yield of 7.41%. Now, if you've been holding this, again, pretty disappointing over the last 10 years at negative 16%, and we do see its all-time high nearly 10 years ago at $41. So let's take a look at the metrics. Dividend safety, 65, it looks to be safe. 58.5 billion market cap, a large cap company. Now, in terms of recessionary metrics, interestingly, increased the dividend during the last recession, below average growth, but did also outperform the S&P with a negative 37% return. Dividend growth 5%, that is pretty nice. You are getting above inflation increase in 21-22 as well as locking in a yield of over 7%. Last 5 years, slightly lower than inflation. Last 20 years, 5% on average. If you are locking in a strong rate around 7 to 8% and getting above inflation year on year for the last 20 years, in my opinion, that is a win. And they are 1 year away from becoming a dividend aristocrat. For those that are new to the channel, a dividend aristocrat is a company that has paid dividends consecutively increasing year on year for 25 years or more. Now let's jump into dividend yield theory. We can see a sign here of reasonable valuation given that current yield in line roughly with that 5-year average. Similar can be said for the forward P to DCF ratio, 7.5 versus 7.7, and when we compare it to the energy sector, it is fairly in line at 7.1. So let's take a look at the DCF payout ratio. Now, we don't look at the free cash flow, although we like to for normal or other companies, but for MLPs, we tend to focus on the DCF. Below 90% is our target, and over the course of the last 10 years, it hasn't gone anywhere near that. 54% in 2022, 57% in 2023. So based on this payout ratio so far, it looks to be safe. Now, when we move to the DCF per share, we see $2 in 2013, $3.5 in 2022. Similar to BMI, it does increase over the last 10 years, but again, do note the inconsistencies, and do note in 2023, it is expected to drop, although very slightly. Now, when we focus on the sales growth, again, you can argue the volatility as well as the cyclical nature of the industry. We see years of double-digit growth followed by negative growth and so on and so on. Now, remember, the key thing is with these cyclical companies is to be buying them when they are out of favor, when they are essentially nobody wants to own them because they have dropped in terms of their sales and other metrics significantly, and then ride it up when they are essentially in favor and the top of the cycle. Total sales then, when we look at this numerically, 48 billion in 2013, 58 in 2022, and we can note that drop there, and it just shows us based on this graph the essential volatility and cyclicality. Also note their share dilution is effective due to the fact that MLPs, as we can see here, retain little of their cash flow due to their costly growth products and essentially their high payout ratios, 1.84 in 2013, 2.2 in 2022. ROIC 10%. Inconsistent, but overall it's something I would be happy, especially when we see the last 5 years and in fact 2023 around that 10 to 11%. And when we move on to the margins, we can see the inconsistencies, but around that 12% for these companies isn't too bad. 11% in 2022, 13% in 2023. Free cash flow margin, it has been increasing, although 1 to 3% is a bit worrying, but given over the last 3 years and in 2023 it is expected to be 10% or more, that is something that 1, I could live with, and 2, something just to keep an eye on. Net debt to EBITDA then 3 in 2022, well below that 4.5, 3.11 in 2023. So even though this company does offer a high dividend yield with around that essential dividend increase year on year in line with inflation, it does look to be safe. Now, in terms of the valuation, as always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button. Lets me know that you enjoy the content, you want me to bring out more content. Now, in terms of the current price, $26.83. If we start off with 10%, it is a buy up to $36. At 15%, up to $34. At 20%, around $32. At 25%, it's still a buy. And we can see here there is some nice margin of safety with this company. Again, a few cents shy. So you're looking around a 35% margin of safety. Now, in terms of what Wall Street believe over the next 12 months, they do see some nice upside, as we can see here. In terms, they see around that 25% upside over the 12 months. So in conclusion, for EPD, we see around 35% margin of safety, with Wall Street expecting around 25% upside over the next 12 months. Moving on to the third stock, which we have as a discounted stock, is AEP, American Electric Power Company. Now 2013, down 12.5%. They are pretty much in the midpoint of the 52-week range. Forward PE around 15.8, yield over 4% at 4.22 currently, and when we look at the last 10 years, they are actually up 77%, and we do see them testing those all-time highs in 2020 as well as 2022 at around $100. So let's take a look. Dividend safety, very safe at 81 score, 44 billion market cap, large cap company. In terms of recessionary metrics, well, maintain the dividend, above average growth, and we see they outperform the S&P, negative 46%. Dividend growth, a nice 6% increase in October 23, 6% over the last 5 years, although the last 20 years has been fairly volatile with 1% on average, not the greatest as a dividend growth investor. And we can see they have been increasing those dividends over the last 13 years. Now, dividend yield theory, we can see that sign of undervaluation, 4.21 versus the 5-year average of 3.45. Likewise on the forward PE with a 15 versus the 18 on the 5-year average. And if you want to compare, it is very slightly lower than the utilities sector at 16.7. Now let's jump into the metrics, and we can see now for the earnings, again, utilities are more volatile, similar to MLPs. We'll look at the earnings. Below 75% for utilities. We can see over the last 10 years, it hasn't touched that. 2022, 62%, 23, 66%. So no worries so far. We can see why it looks to be very safe. And we can see the growth to the earnings per share, 323 in 2013, 509 in 2022. There are some inconsistencies, but likewise with the other two companies we looked, over the longer term, it is moving in the right direction. Sales growth, again, note the cyclicality, the volatility of the industry. We see some years negative growth followed by positive growth. And in terms of the numerics, well, 14.8 billion in 2013, just under 20 in 2022. So again, it is moving in the right direction, but sometimes you just need to think whether or not this is a type of company you want to invest in. Different investors will have different goals. And similar to the other two, they do dilute your position as a shareholder, as we can see those shares outstanding increasing year on year. ROIC then, below the 10%, but however, for utilities, we can bring this down to 7.5%. The last few years, it hasn't really got to those levels. The same in 2023, but something just to keep an eye on. Consistency isn't bad if they are managing to operate well at 5% level. That isn't something that should concern you, but it is something that you should just keep an eye on. And it's positive to note their operating margin has been around that 18% or more that we target for utilities. 2023 coming in at 20%. Now, in terms of the net debt to EBITDA, 5.83 in 2022, 2023 expected at 6, which is above that 5.5, but do note 2024 it is expected to come down to 5.23. Now, let's jump into the valuation for AEP, and don't forget you can click on that pinned comment below, grab a copy of the valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio or on your watch list. Margin of safety then 10%, a buy up to 90.8. Then we move it to 15%, it's still a buy. And at 20%, we can see it currently straddles between 15 to 20%. Now, in terms of Wall Street, what is their upside over the next 12 months? We can see here they do expect around 10 to 15% upside. So in conclusion, for AEP, we see around a 15 to 20% margin of safety, with Wall Street expecting 10 to 15% upside. So in conclusion, we do have 3 stocks there which do look to be great over the next few years. Lots of upside, lots of margin of safety, but do let me know your thoughts in the comments below. Are there any in particular that you have been adding or you have been adding to your watch list? Or if there are any that you are looking to avoid, do let us know. As always, smash the like button if you've enjoyed the content. Hit that subscribe and bell button so you are notified of these videos as they regularly drop. As always, have a great day. Catch you all on the next episode and take care.